Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, February 7th, 2024, and this is Blockhead Traders Weekly. In this week's episode, we got a special 1-year anniversary episode from the last time we did this before, and we are bringing back a special guest, Silverback. Last time he appeared here was approximately 1 year ago, and we're going to see what he's been up to and get some of his thoughts on some discussions that Viper and I are going to have. And Viper and I are going to touch on the wOOOOF trade, earnings trade that I had from a couple weeks ago, actually last week, not a couple weeks ago. That one didn't quite pull it out. Oof. So I'm going to kind of go over that one with you guys. And then we're going to touch on Viper's experiment with the Bitcoin ETFs. It's been running now for a little while. He's got some data under the belt, and we are going to jump and see how that is looking these days. But before we get to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You'll also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. And if you can't find it wherever that is, let us know and we will get it there. So let's get started in this week's episode. Viper, I know you were not around for the past couple recordings where I picked out a couple of earnings trades, and then the following week I went through and I fired up, how those things were going. I brought up my infamous Flappy Bird chart because a lot of times when I play these earnings, I'm playing them with a strangle, which means there's a top and a bottom side. In last week's episode, I had 3 earnings trades on. I actually had a trade before that, so this is the 4th trade. This wOOOOF trade was the 4th trade here in 2024, and this one didn't pull out of its dive. So let's take a look at this Flappy Bird chart, and I'll just touch on a little bit about, this is exactly, the contingency plan that I had factored in. And so just before earnings of wOOOOF, I had opened up a strangle, and I marked those with the 2 red bars here, the top and the bottom, the first set that you see, the 2 red blocks. Earnings came out towards the middle of this or start of this red block. And really what I wanted to see was, the announcement and the underlying to stay somewhere between here. And the backup plan was if we didn't and we went through the ceiling or we went through the floor, the idea was to roll that option out in time to collect more premium to wait to be right. And earnings came out, they were disastrous, and the stock really fell big after hours. I think it fell almost 10% after hours, and then I think it fell an additional 5% the next day. I actually had the opportunity to close this thing probably about a couple hours after market open for maybe about a 20% of my premium collected. That was about the best that I got, and I almost closed it out. But the plan was really to either hit my 50% profit target or to take that thing into expiration and roll it. If I got early assigned, I got early assigned. I was okay with all of that. And so sure enough, the trading day went on and it got worse and worse and worse. And you can see we started breaching this $30 strike down into that red box. And so what I did was I rolled it out in time. And rolling it out in time is basically buying back what you have that was expiring that day. There's almost no time premium left in it. So it doesn't cost that much to buy it back. Except for the intrinsic value of where you've breached your strike. And then you turn around and you sell the same strike, but you sell it out in time. So I went out to the February monthly, which is a February 16th expiration date, and I collected an additional $35 per contract. And I had 4 contracts, so I collected a little over $100 from pushing that out to February 16th. And I didn't touch the call side because the call side was going to expire worthless. I keep all my premium, so I let that one expire worthless. This next bigger, wider red box is basically what I've rolled. And so I lowered this box. The strike is actually still $30, but what I did was I lowered it, factoring in the premium that I collected from the strangle as well as the roll. So this is my cost basis now, is a little under $28. So it's $27.85. And so basically I have until February 16th to try to get above $27.85. If I do, then great. I can kind of close this out for a profit. I can choose to roll it to collect more premium as we come into that February date, 16th. But you can see here's my Flappy Bird chart. I failed. I hit that bottom tube, and I'm stuck in the red zone. So basically, this one is a loser right now for me.
Game restart. Broken.
Yeah, we'll just go again. But honestly, three winners, one loser, and it's really only a loser with an asterisk, right? Because you didn't really lose, you just didn't get to close the trade as quick as you wanted to. That's the beauty of the options.
Yeah, and I mean back it up too. You said 3 winners, 1 loser. So I mean, going back to position sizing, risk mitigation, and all that kind of stuff. That assuming the approach to every one was followed the same similar template. That's a 75% win rate, and all wins and losses being equal, that's a good batting average right there.
Yep. No, it's an excellent thing to call out because statistically, my hundreds and hundreds of trades, probably broaching in the thousands now of this type of premium selling, I average about a 72% win rate, I believe it is. So, yep, that's statistically accurate. All right, Viper, I'm excited about this episode because it's been 1 year since Silverback has been around, and I thought I'd gather all the little nuggets of Blockhead Trader things that I have. And so I didn't actually tell you this beforehand, but this is a Blockhead Trader show. So I decided to get my customized Blockhead Trader whiskey glass labeled Sprocket here. That was a gift from Silverback in the not so distant future, and it is actually filled with some Woodford Reserve because we actually had a Blockhead Trader meetup here in Columbus in just before the holidays, where one of the other traders in there was so gracious to share a bottle of Woodford Reserve with me. And I also, this is the first time appearing on the show, I have from our crypto episodes, Viper, you produced this beautiful 3D print of my chicken with a wonderful light bulb coming out of its butt. We got some tentacle arms, and my children have affectionately named this chicken Bathsheba. And so is going to make an appearance in this episode. I didn't have a place to like perch it somewhere, like on my microphone or something would have been cool. So it's sitting next to me.
That is the first. That is the first printed real life NFT from the biggest blue chip project on the Avalanche blockchain. So there's a piece of history right there.
That is. This is it's probably going to be in some sort of Smithsonian someday. That my children's grandchildren, we'll get to check it out and read.
When everybody has digital poultry, digital farm animals, then that'll be here was the very first IRL chicken.
But let's go ahead and bring in our beautiful special guest here, Silverback. So welcome, Silverback, to the show again. It's been a year. And
hello.
How you been?
Thanks for having me. Oh, I've been all right. I did. You were asking me what happened a while ago since last time being on the show, and I didn't remember anything because I didn't do a lot with respect to trading. I did remember one. I did remember I read a book that one of the Blockhead traders suggested. It was the Flash Boys about high frequency trading, and it was fascinating. And it brought to light a lot of the concerns I had with the idea of trading and having sort of a speed advantage
I'd say that all counts.
to
That
your
counts
trades.
as progress on your journey.
Yeah.
Yeah.
Uh,
If,
be-
if I remember, that was recommended by the Woodford Reserve trader that gifted the Woodford Reserve to me.
oh, there you go. So it was a good book. I would recommend it if anybody else works in hardware and likes to think about what happens in between clicking sell or buy.
So what'd you say that was called?
And
Flash
how you,
Boys?
Flash Boys, yeah.
See, I just picture some little like printed receipt coming out of a little like when you go to a fast food restaurant and they print your order. Not fast food, but you get this little order ticker and it goes in the little chain, right? And somebody's like, "Oh, go get this for him." That's not what happens when you push buy and sell.
I mean, I guess in a way, it's just a bunch of digital.
Yeah,
digital
but more
links.
importantly, it's all very direct, secure. Nobody knows what that order is until it's already hit the market.
Oh yeah. They don't talk about the bank pools where they would match buyers and sellers before it even hit the open market or anything like that.
Yeah. So
Ripe. It's ripe for all the great characteristics of human life.
Yeah, so silverback. One of the things we've kind of covered recently on this show, we flip back and forth because Viper is the crypto, our official senior crypto correspondent, and I typically cover options premium selling. But the media was all abuzz on this Bitcoin ETF in the not so distant past. In fact, it kind of drug on for months and months and months leading up to the actual announcement of a Bitcoin ETF. Is this something that you read about, knew much about, followed, had any opinions or thoughts of? Because I know Viper has an experiment we're gonna hop to and kind of go through, but just curious on your take from your world conversations, water cooler conversations, if you would, around Bitcoin ETF.
As a plebeian to the trading world, yet I did hear about it briefly, but not anything that took up any stack space in my head. Mainly, ever since our experiments with Bitcoin that so long ago, I have discounted it as it and many other cryptocurrency type things as sort of for the trader type people, and it's not particularly reaching its potential of where I see the most interesting stuff happening, where you can actually create applications and things on
if
it.
If I could contextualize slightly without saying too much about what you've done in the past, like you started, I think most people, even if they're not really into crypto, they know the blockchain Ethereum, and you were dabbling around before Ethereum. I mean, you were dabbling around on Ethereum on testnet before mainnet, right?
Yeah, and we went to the federated ones that J.P. Morgan Chase was setting up. I forget what it was called, but Quorum. It ended up calling Quorum, and then they ended up selling that. And I made an application on that, which was cool. But then I couldn't quite keep giving my heart to it when I knew it could just disappear because of some whims of the most popular chain, or somebody decided they could get rich quick over here, so everybody jumps chain.
Which is an interesting dynamic, which still plays out to this day, and probably in an even more gross fashion that would disgust you even more than you were back then. But I mean, I see it at a high level that you experienced the technology of the blockchain, which we've kind of talked about in the past a little bit. But obviously what really turned you off was how the technology was either flat out ignored or just nobody cared. And they were like, but I can make this worthless piece of paper token and everybody's going to buy it, and then it looks valuable, and so let's just do that instead of do something useful and meaningful with the technology, which I think is totally fair of the space. And I'm still in the hopeful camp of this is the Wild West phase of like, this is mostly garbage. The technology is still there. And I'm pretty sure, without putting words in your mouth, you still believe the foundation of the technology is still good. But there's a lot of shaking out and a lot of I would even call it boring adoption that needs to happen, to where nobody's talking about SQL databases around the water cooler. The blockchain needs to get to there where it gets back into the corners and the back room of technology where it belongs.
I don't know where you work, Viper, but we talk about SQL databases around.
Yeah, water cooler wasn't the right the town square in line at Best Buy.
Yeah, the one thing that I do accept it, like, I don't have an immense amount of knowledge around what the show's about, trading in general, and it is maybe a necessary component. I just think it's outweighed in those realms. You need it as sort of this engine to drive it, right? You need some people to speculate and some people to just mess around with excess capital.
Yeah.
But I don't want to be at the whims of them, which is kind of my issue with stocks in general, is that it's at the whims of people and their feelings.
Well, let's set this up here, Viper, because we'll refresh the memory of our viewers and educate Silverback here. The Bitcoin ETF that we've been waiting for and that we're going to talk about is a spot ETF, which is different than the product that was already out there, which was an ETF on Bitcoin, but it was based on futures of Bitcoin. So the spot ETF is basically an exchange-traded fund which is intended to track the price, the spot price of Bitcoin, which going into this is an interesting dynamic because Bitcoin doesn't have market hours. It trades 24/7. It also, it's all digitally traded. I mean, stocks are digitally traded too, but it's kind of a commodity. It's kind of a hybrid of all of these things. And at launch time, the SEC basically approved 11 different Bitcoin ETFs by different fund managers and things like that. And it's kind of interesting because a lot of times your exchange-traded funds are a basket of stocks that represent either a particular trading philosophy, a particular company ideology, like green energy, technology stocks, and it's just this huge basket, and they can be either passively managed or actively managed. The difference is passive means there's not a human choosing what to do. It's some sort of algorithm that's all based there. Actively managed means they hire actual people, managers, teams to decide what to do. And it's kind of interesting because this is just a spot price. There's no other components into these baskets. And so going into this, the day of the announcement, you queued up orders for all 11 Bitcoin ETFs. I think it was $100 in each one. And you said, let's see what happens. And so I'll turn it over to you because this is an update on that experiment.
Yeah, that's pretty much summarizes it. And just to reiterate, the goal here was obviously to compare what's my performance if I choose one of these ETFs versus if I choose to just self-custody hold my Bitcoin. Obviously, certainly my perspective is I'm just going to self-custody hold my Bitcoin. But the whole point of the ETFs and equities and all that kind of stuff is it opens up things like my retirement account, where maybe I want to take a 2.5% or 3% sliver out of it and expose it, given my own time horizon to retirement, and give it some exposure to this ridiculously volatile asset class. So in the world of my retirement account, there is no such thing as self-custodying Bitcoin. And so therefore, to gain that exposure, we would do that through one of these ETF products. So like you said, the goal of the products is to track the spot price. And so therefore, that doesn't mean the value of one share. Obviously Bitcoin's trading right now around $44,000. that these share prices can be whatever they want it to be, and they obviously bring that down to a reasonable trading level. So like $20 to maybe even $16 to $40, somewhere in that range. You can do that just with supply and, you know, all that kind of stuff. So the point is, if Bitcoin drops 10%, the share of these ETFs is expected to drop 10% as well. But kind of what we've talked about before in the past is all of the inner working mechanics of the on-chain versus the equities world. So the whole point of the experiment was, does that hold up? Do each of these products boringly trade exactly in lockstep with Bitcoin? Or is there something else that we need to evaluate when we're trying to decide where to put that those equity accounts into which one of these? Which does not mean that this is financial advice by any means. So with that in mind, let's take a look and see how they actually held up here. So a couple different data visualizations here. The main important thing is to keep an eye on this green line, because this green line is what is 0%. So it is the performance of Bitcoin against itself. So it's 0%. These little circles here on the leftmost column, that is Bitcoin. So yeah, of course, all of those dots are right on 0 because Bitcoin performed perfectly against itself. The rest of these are clusters. Each color is a different day. So I didn't collect this data as scientifically as I would have liked, but there was some method to it. And every time I collected the data, I did it the same every time. So whether it's off, it's all off together, presumably, in theory. But each color represents a different day in which the data was collected. And we can kind of start to see these clusters forming. And obviously, like I said, the closer to green, the more perfectly in line with Bitcoin you are. The further you are below it, then the worse you are. And the further above it, you're outperforming Bitcoin. And so what is interesting is the spread here. As you can kind of see, there's a couple outliers where you have this GBTC here, which consistently every snapshot was outperforming Bitcoin, which I thought was interesting. And we'll loop back to that in just a second. Meanwhile, right next to it, this DeFi one, and I believe I'm not even gonna. Well, we'll see the list here in a second. I forget the name of the custodians, the trust for DeFi, but this one was all over the map. Some days it was outperforming, some days it was way underperforming, as much as 1.49% below of Bitcoin. So very widespread on that one. Something like BTCO here, clustered very closely together every snapshot. So I thought this was all interesting. And it doesn't tell the whole story, though, because you would look at this and you would be like, well, shoot, GBTC here is outperforming Bitcoin every single time. So doesn't that kind of make it better to hold GBTC than it does to hold Bitcoin itself? Like, why isn't everybody just piling into this thing? Which some people are. But there's this whole aspect of fees, which I think is critical. And we mentioned this when we were going over the initial spot ETF filings, that you really got to pay attention to the fees. And that's part of your due diligence when you want to get into any ETF product, is see how the fees are, what are they charging and all that good stuff. So if we break it down here and look at the fee schedule for each and every one of these, we're not going to go through these one at a time, but you can see 0.2% is pretty standard. Everybody's kind of competitively jockeying around 0.2 to 0.29, 0.39. And then all of a sudden you got...
Oh my goodness, they're advertising GBTC on your website.
Yeah, right.
This is the best ETF.
And I wonder where they're getting money to do that. Oh, it must be right here. GBTC.
Oh, there it is. 1.5%.
1.5% fees, which is astounding, not just amongst its peers, but it's kind of astounding amongst managed ETFs in general. So I went and looked, and a pretty passive ETF, something like an index, is usually around 0.09% is what the SPY fee is. Something a little more actively managed, like ARC-F is what we looked at from the ARC Kathy Woods Foundation, which is a basket of assets actively managed for you. That is clocking in at 0.75%. So you can see that in that scale, it is, most of these are residing between that passive index to the very heavily actively managed ones, with Grayscale just sticking out like a sore thumb here. So that is important context that we need to account for, because when we're looking at this here, that doesn't tell the whole story. We need to normalize to our fees. So on this chart, we kind of went to this line thing so we can see the clusters a little more clearly here, but it's the same exact chart. It's just added in the fees to it. And all of a sudden, everything's below zero, which is fine because we expect this to be less than holding Bitcoin spot in our own self-custody. But what we want to see here, what I want to see, speaking as me, the investor who's about to invest in one of these bachelors here, I want to see a nice tight coupling of all the data points, because that tells me that you are consistent in your performance, and I'll decide if it's good or bad as to what the performance is, but be consistent in it. So we do see that we get that on a number of these. BitB here, nice and tight there. IBIT, EasyBC. You can see that there are some well performing when it comes to consistency. You know, DeFi once again just wild across the board here. No idea what's happening with that. So I'm definitely not going to invest in that one. But now something blending the tight coupling and also closer to zero, the better, because those are fees that are going to be coming out of the position being held. So all of a sudden, GBTC, which had been outperforming Bitcoin, is now in the bottom ranks of the most expensive, as it kind of spreads here from anywhere from negative 1.28% to negative 0.84%, which is kind of up there on the cost. So for me personally, what I thought was the most interesting, and I want this data to be better collected, more scientifically collected, just to make sure that it holds up. But BRRR, which is the Valkyrie index ETF, this one looks pretty good to me. It ranges from 0.62 to negative 2.2%, which is a pretty nice coupling there. Now, I've been kind of ignoring this yellow line for a second because this is not really factoring into my decision. This was an intentional data point that I selected as an outlier because my thesis was that it would be an outlier. And so the yellow line there was on January 31st, FOMC day, and I took this snapshot an hour after the data was released from the Fed on FOMC, and I wanted to catch that snapshot because notoriously, I mean, equities do this, indexes do it, stocks do it, but on a big news event day like that, there is wild volatility. News is still noise, doesn't change the trend of the chart, but there is some wild volatility that happens. So I wanted to grab this snapshot to see if the thesis was true that these ETFs are going to lag the asset underlying on a highly volatile day. And it seems that does appear to be the case in most of these ETFs. The yellow is quite an outlier compared to the grouping. However, I do think it's important to note, or interesting to note, I mean, DeFi is all over the place, so it doesn't really look any different than any day for them. But when it comes to GBTC, I thought it was interesting that the volatile day on Bitcoin didn't really have much of an effect on their general performance. And that also seems to hold true over here on BTCO, which BTCO is run by Invesco Galaxy. So what was interesting about that being grayscale is GBTC, as we talked about on the previous episode, has been around since 2015. So my theory is grayscale knows what they're doing here. They've been doing this since 2015. Volatility in the underlying is not something new to them. And for whatever, and through whatever mechanic, I sure hope it involves that 1.5% fee. They have found a way to buffer and keep a tight track of that underlying. And that would make sense why something like BRRR or one of these other ones might be struggling with their initial boot up methodology, that when it gets volatile, they stray outside of it. So mostly an interesting data point. Like I said, it's not going to change my decision per se, but it would change my entry point as to make sure I'm not buying on a highly volatile day. But other than that, that's what I found. I thought it was kind of interesting. I know, Sprocket, you thought that we were just going to see a big fat flat line of nothing burger here. So was any of this surprising to you, or do you see this all as what you expected?
Yeah. Listen, can you go to your dot plot? I think that's the best representation of the different graphics that you showed here. Honestly, I was kind of surprised at your DeFi one. Like it's just wildly all over the place. Even Burr to that effect was pretty spread apart. A lot of the other ones were really clustered where I kind of expected them to be. And most of them were under the line of Bitcoin performance. So that kind of was my expectation, is when you're trying to track something, a spot price of a single thing, right? It's hard to ever be better than the thing you're tracking. So I to be honest, I was a little impressed that Grayscale was such continuously performance above the underlying. Because think of it, it's like, I don't know what's analogous to, but you're basically kind of creating something that out of nothing, right? You're basically doing better than the underlying. Hold on, I was going to have a thought there.
Along those lines is something we've talked about to anybody getting into crypto or any of these very highly speculative hard hat area things. Know where the yield is coming from, or else you are the yield. And so in this particular case, I mean, I agree. I had the same thought. Like, how are you so consistently outperforming the thing you're tracking? There has to be new money somewhere. So obviously that 1.5% fee is a significant, I don't want to say red flag, but certainly a potential. What is happening with that fee? Something appears to be happening with it that pours back into the maybe not the underlying, but the share price itself. I don't know. It feels like something's going on there with that. Not necessarily in a bad way, or it's just that's the only source of new money above and beyond that I can point my finger to as to what could possibly account for that.
So what is it if you're buying this? What are you buying when you buy GBTC? Like I agree with what Sprocket was saying, that how could you possibly outperform holding something?
Yeah. So what I believe is happening here is you are turning money over to a fund. So think of a couple of dudes in their basement. I mean, these are probably sitting in an office maybe, but you're giving them your money and you're saying, hey, I want you to spend this money on Bitcoin and do your best to maximize my Bitcoin return. And so they go into the Bitcoin market and they look at it and they say, okay, we're dropping, sell. And then the Bitcoin's down, buy it now. Oh, it's rising. Okay, sell. Oh, they're basically trading these minor waves in the underlying price, and they're doing it actively. So it's not just I plunk down my money, we'll see what happens whenever you want to exit. It's while they're holding your money, they're taking that money and they're actively trading the price swings of Bitcoin. Short this, go long this, that type of thing. And so they're doing the trades, but only on the Bitcoin. And that's effectively what you're doing is you're turning over your dollars saying, you know what, I want you to go actively trade in Bitcoin and try to make the best return as possible.
And is that contractually by definition of what these things are?
Yeah, you'd have to read each individual prospectus. So every time you have any sort of exchange traded fund like that, they issue a prospectus. And that's basically you could say a contract for lack of a better term, but it tells you exactly what they're going to do. Or in some cases, it'll tell you very vaguely what they're going to do. We're going to invest as best we can in the sector of financial markets or something. Like, it's not really written like that, but they can be as generic or specific. So some ETFs will say, we will hold exactly no more than 57.4% of Apple stock at any one time. And they'll basically describe what it is you're giving them money to do. And so each one of these Bitcoin ETFs will have a slightly different prospectus, but it'll tell you what do they trade the Bitcoin on, who holds the Bitcoin, because Bitcoin, right? It's actually a real thing. And so is the firm that's doing the trading holding it? No, they have custodians, and they list who is the custodian of it in those prospectus documents.
So Viper, since you bought $100 in each of these, did you read any of the prospectuses? Especially the GBTC
I did.
one?
So that was part of, I mean, not the whole thing. The prospectuses are 140-page documents, but
it's like
but I did
manual.
scan through not each and every single one of them. But on the previous episode where we were talking about them, what I considered the really important things as far as getting into this specific asset was I went through a handful of them, and we kind of showed on the show as to where they talk about who's the custodian of the BTC of itself. Is it on chain? Is it off chain? Is it in a centralized exchange? Is it in a hot wallet, a cold wallet, all that kind of stuff? And I was honestly surprised. I shouldn't be surprised because this is the key benefit to a regulated market. They were very thorough on describing exactly where the asset was being held, and if there was any vagueness, so a lot of them have a lot of vagueness between hot wallets and cold wallets. And they basically say, hey, that's up to us to manage what's in a hot and what's in a cold. We're just not going to disclose that. So, that was details like that were pretty forthcoming, which I thought was like I said, it was interesting, or it was surprising to me. Maybe it shouldn't have been surprising because, again, regulated market and all that kind of stuff. So I breezed through several of them and looked for those key areas that I thought were most important to what is the risk vector here of, should they lose their wallet? Should they be subject to a hack or exploit or something? So the other thing that I want to say that you kind of, as you were talking through that, Sprocket, if we were to give Grayscale the complete benefit of the doubt as to how they could possibly so consistently outperform the underlying, I think there's a very real argument in, again, 2015 is when they started doing this, and the space, like let's just say Bitcoin in general, is notoriously manipulated as far as the price of it. And, it's just, I mean, that's the number one argument from Gensler, from the SEC. Their concerns around it is how easily manipulated the price of it is. So giving Grayscale the benefit of the doubt as to where this surplus is coming from, because let's be honest, I don't think any of that 1.5% fee is getting cycled back into the underlying. That's just going in their pocket. Like that's just, that's their bread. So if you've been doing this since 2015, you are going to have just be miles ahead of your peers on the street smarts, if we will, as to who the big players are. What are the signs that somebody's about to, that Binance, I mean, we'll just call out them because they are well known for manipulating the price of assets, for liquidations on their platform and all that kind of stuff. There's all kinds of stuff you can pick up to better maneuver your trades. So a little bit to kind of what Sprocket was talking to there. I would certainly not doubt that some of that is involved with how they manage these assets. Because then to what you had asked, Silverback, as far as what happens when you buy this, I mean, at a very, very high level, it's like you give somebody $100 and say, hey, you promised to give me performance similar to Bitcoin. So I just expect that. But you turn over that $100 and it's completely up to them as to when they trade, when they buy or sell and swap that money in and out of the underlying. So I would say it's not beyond the realm of possibility that Grayscale is just really good at trading Bitcoin at this point.
Yeah, the one other thought I'd throw in here, which is kind of what I, call it maybe confirmation bias. But I think this really kind of confirms what's the point of these. And when I think about what's the point, the reason I phrase it like that, right, and it could just because I have this strong aversion to paying somebody to do something that I could do myself. And when this isn't like a complex ETF of balancing and understanding a basket of 50 different technology companies or 50 different financial services company and paying attention to their fundamentals, their earnings, their this, that, and the other, right? This is one thing. Bitcoin is roughly, similar to a commodity. It's an object, it's a thing, and you're trying to track the price of that. And so I'm going to turn over and pay somebody to try to match the price of this by trading around it. When in reality, most ETFs that are trying to do this are going to lag to some degree the actual thing itself. You're a derivative of it. And then you're paying a fee on top of that. And it is an actively managed fee. And so I'm sure that we could get a great, beautiful counter argument, but you're actively managing like one thing. And it's also a one thing that is majorly traded in the world by algorithm bots. Okay. So like the whole crypto world is filled with algo traders. And so fundamentally, I just don't see why you would not pick up and hold the Bitcoin. You could say, well, it's hard. It's confusing. Maybe that means there's a market for making things easier, which I think Coinbase and stuff like that is largely done for the retail trader. So I don't want to really sound negative on it. I would say the one benefit, and you alluded to it at the beginning, Viper, is if I wanted to put some of my retirement holdings, right? Those are going to be in a separate IRA account or things like that, right? You can only use that money on things traded on the open market, the exchanges and things like that. So if you wanted to get exposure in your retirement account to things like a cryptocurrency because you thought that's going to be the next thing, it's going to grow, and it very well could. I'm a firm believer in the technology itself. That to me is what these ETFs are really for, because that's an area that you can't otherwise do something in that trading account, let's say.
Yeah, you get the exposure and you get to use your pre-tax dollars and
Exactly. So that's something you can't do without these ETFs. Now, I don't think that that's really how they marketed any of these. I think a lot of what the media talked about and a lot of the way that people talked about this was, oh yeah, I'm going to go on my TD account, my Schwab account, and I'm going to buy some ETFs, right? If you're doing it as a retail trader, you're basically taking, in my opinion here, you're taking a haircut on your returns simply to buy it from an over-the-counter easy thing, when you could take an extra 5 minutes and go to a Coinbase and buy the real commodity and probably get that haircut back. So that's the part that I just don't like that part now. The retirement
but
part I can see.
Would that not also simplify your returns in the end? You have one brokerage firm that gives you your tax documents at the end of the year, tracks all this trading for you. You don't have to.
You could say that, but coming from an individual who has multiple brokerage accounts today, I really don't find my taxes any more complex because they're all kind of automated. You get your 1099B and it says what's in box whatever, right? So even Coinbase is going to give you a 1099B. And it's just instead of saying add bank, add broker, right? You add one more 1099B. In fact, most of them auto pull your tax information from the brokerage account itself. So yes, there's some centralization. And like I said, if that is worth that haircut you're going to take to you, then go for it. But I'm more of a, why would I pay you to do that when I could do a couple of extra steps on my part and not give up that yield?
Yeah. I think we're reaching the point of trading where my perspective is different from the active folk. Like, I can't think of anything more boring than trading stuff. Like, so anything that's going to take that and let somebody else have their day with it or whatever, and if it's a haircut, then it's something out of sight, out of mind on my end.
Which
I do think the prospectuses should probably be simpler, because it kind of sounds like a hole for all the legalese and working around different understandings. Kind of like WOOOOOF.
I'd encourage you to read one first, because I think there are a lot of those padded legalese EULA stuff in there. But I think the meat and potatoes, which is why Viper said, yeah, I looked at them. I didn't read all the pages. The piece that tells you the important bits are really quite easy to find. And they're pretty bright. There's a lot of other, like how they pay management, blah, blah,
yeah.
blah.
And I would say if you go into one of these prospectuses and you don't know what you're looking for, then you're ahead of the cart's before the horse. Like, I mean, because we also talk about in any investment of any ETF, of it, like, know the underlying, know what you're investing in, and build from there. And so that's why, like, when I opened up a prospectus, I was like, all right, I'm searching the keyword Control F. We're going to search custodian, and I want to see what are your answers for around the word custodian. Like, that's might not be something that somebody who's never touched cryptocurrency before, never touched, like, you wouldn't have any idea that that was a thing you need to worry about. And so that means if you don't know what you're looking for, you're jumping in too soon. Like, know what you're getting into.
It's kind of like, why is this person got a mop and a bucket?
Sir, this is a Denny's.
I do think reading different prospectuses from different ETFs, I do think these Bitcoin ETFs have a lot more ground to cover, because you're dealing with an actual thing that somebody has to hold and what happens to that thing. And you can't really buy that thing on the same exchanges that the ETF is on. You have to go to a different exchange. So I think a lot of that prospectus really talks about all those extra steps and how it's controlled and managed. And so, like, if you pull the ETF on just a true exchange traded fund that's a basket of stocks, some of those are extremely brief, 5 pages tops. So I do think that the way that these Bitcoin ETFs, because they have lots of layers in how where do you hold the Bitcoin, who holds the Bitcoin, and how do you pay the active management. Any active traded fund also typically has longer prospectus, because they have to explain how they compensate management, how often do they rotate management, when will they fire active management because of underperformance. Like, it's a bunch of, like, garbage that you probably don't care that much about, that kind of inflates the document size.
So, but I would also back up to the one thing that, as both of you were talking at one point, that kept going through my head is one of the best movies of all time, Tommy Boy, and the guarantee on the box. It's got to say it on the box. I feel like that's at play here a little bit. So I 100% agree with you, Sprocket, as far as like, if you want to hold Bitcoin and we're outside of your retirement account, just learn how to hold it yourself, self-custody it, and then you just don't worry. You know that you own it because of XYZ. Like that's it. But I feel, and so I'm all for that. I'm obviously also all for the retirement account argument for it, for these products. But I would say there's, and it is unfortunate as far as the marketing, because I agree. I feel like these are definitely being targeted at retail, which I don't think is a good idea for any retail to get into, but it has that feeling of the guarantee on the box that, it's intimidating. I take a lot of that intimidation for granted, having been so deep in the space, but it's intimidating. And so sure, it looks like my choices are DIY, and in any realm of life, we know how DIY can be looked upon. Or I could buy the, slightly better, go to a centralized exchange, go into Coinbase or something like that. But then I also hear all of this stuff about centralized exchanges crashing and going insolvent and all this stuff, like they're unregulated or whatever. So I don't know. That's a little better than DIY, but I don't trust it. And then you go to like this gold standard of it's in my brokerage account. It's regulated in the NYSE and all this other stuff. Like, so whatever they want to charge me, just do it. And so I feel like that's certainly at play. I do think it's unfortunate, because I definitely believe that if you're a retail and you think this is giving you efficient exposure to Bitcoin, it's certainly not. But I feel like that mentality is playing a factor.
I want to be careful in this recording that what you just said doesn't get misconstrued a little bit, because at the end of the day, Coinbase and the custodian and the trading is where these ETFs are happening anyway. That is. I get what you were saying in principle and in spirit, but don't take that as, oh, these ETFs are separate from Coinbase, because a lot of them rely on Coinbase on the back end in the prospectus.
So, I mean, also to the point, you can make a Cuban sandwich at home
just
for
a
not
sub
$15.
Sandwich. Don't even be fancy with a Cuban.
Right? Yeah, there's a reason for markups.
Yeah,
and it's to put fluidity to the currency that we use. Right? It's the point to spend it so people can be employed and work in different areas. I think.
I'm not opposed to the markup or the haircut you're taking. Just don't think that it doesn't exist. Yeah. I guess that's my point. Just understand that you're taking a haircut on that for the convenience of it. Or
pushing it just one little tiny step further. Accept when it's acceptable and understand why it might not be acceptable. So, and that's what leads into the whole retirement argument of it is fully acceptable, especially when we start thinking, like Silverback brought up, of pre-tax dollars, or if this is in an account. I mean, there's accounts where you can grow tax-free, you can grow gains tax-free, and so like in an HSA or something, like you can grow things tax-free, and so in that case, that's potentially completely offsetting any of the fees, any of the management fees, or any of that stuff, due to the potential for that. Again, not financial advice and not projecting any forecasting of future performance.
I think unlocking those dollars is much more attractive to me, because to me they're already lost.
That's ultimate out of sight, out of mind.
Not lost.
Yeah. I mean, you could claim they're not lost, assuming your currency does well. It doesn't do the Greek thing and all this other stuff. But to me, it's not affecting. It's put to the side, out of sight, out of mind, and now it's the ability to attach the out of sight, out of mind with something that maybe I know something about.
Yeah.
Before it was just like, take whatever Vanguard says. Yeah, it's good.
Yeah, I think it's rooted back into what Viper said at the beginning, or towards the beginning. Know what it is, know what you're giving up, know what it's costing you, and then I'm perfectly fine with it. For me, it's not my bag of donuts for that retail trader. It's why I choose many times to go purchase something from a local vendor versus a supermarket store, right? Like I realize I can get that thing at a lower cost in that fits that sense of going to a supermarket, but at what cost is that lower price? And it's the same thing here. I mean, it's not really a lower price, right? What cost is that lower return for you? It's convenience. If that cost is worth it for you, then go for it. But just don't think that this is the same thing as trading the underlying directly.
Yeah, I would say that it almost just, if this is the only graph we look at, the BTCO is the one that looks like it just bought it and held it, and then you got charged a fee, and it's just kind of sticking with it.
I mean, it's
that was the tightest. Yep.
It BTCO. I overlooked that one when I was initially pulling this data, but that one definitely, for those same reasons, like caught my attention. That's a really tight little cluster there. And I mean, when you factor in the fees, it's a little worse, but it's really good performance. So I might have to look into that one a little bit closer as well. But yeah. So Sprocket, as somebody who you've started to really, as far as I understand, you've started to really manage those retirement accounts much more hands-on now. I don't think you're anywhere near 100% managing it, but a lot of your options plays and things like that, like those are tying up, moving capital around in those accounts. Is something like crypto exposure desirable given how hands-on you are already with your retirement accounts?
No, I think it definitely is. And that's why I said that's the one area where I definitely can see for me, a legitimate use case is that retirement. I can't really get exposure to the cryptocurrencies. The only option I had before were ETFs based on Bitcoin futures, which for a retirement account is effectively kind of the same thing as I don't think there's a big difference between Bitcoin futures versus spot ETF. So that's definitely something I could see in my retirement account. I would mention, because I don't know that we've actually covered this in the show, but I'm actually going through a little bit of a review of my retirement accounts because I have thought that, I should do a lot of diversification myself. I should do a lot of active management myself. And I've been trying to back test and wait. So right now I think I have a basket of, 20 some different holdings across whether or not it's domestic small cap, domestic mid cap, large cap, international financial bonds. I mean, just as huge. I won't say complex, but a relatively extensive distribution. And I'm like, geez, you know what? I really don't see a ton of back testing difference when, say, in domestic large caps. I think today I have 5 different domestic large cap funds that I trade. And I'm like, I really could just pick one and roll with it. And it's more of distributing the funds equally between the types of asset classes rather than trying to fan out in there. And so, yes, I'm looking to consolidate some of that. And yes, I think one of those categories that belongs in there is a crypto exposure. Whether that's a spot ETF or a futures ETF, 100% it does, in my mind, make sense to hold something in cryptocurrency in a retirement account for the sole basis because my hypothesis, my philosophy is cryptocurrency is only going to expand in usage and use cases. We're at the very infant stages of cryptocurrency, in my opinion. When I lost everything at Mount Gox and we covered all that stuff, that was like in the pre-birth stages.
That was the birth canal.
Yeah, that's exactly.
And it was a painful canal.
Yeah, so I'm a firm believer in the technology and where it's going to go, and so yes, absolutely, I would love that exposure in my retirement accounts, and this now does facilitate that. That's the end. My cup's out. So that brings us to the end of this week's episode Like I said, super excited about this episode. Hopefully you enjoyed it. We got special guest Silverback back in here. We really had, I think, a pretty exciting dialogue there on cryptocurrencies. Yeah, we touched on what happens to an earnings played when it kind of goes south on you. You manage it, you roll with it. We'll keep you posted on how Wolf pans out. I'm confident that we'll eventually pull out of that. I'll close it out for a winner, and it'll just go into that bucket. We'll have to ride it out, have to deal with the drawdown. Crypto, Bitcoin ETFs, it's definitely a thing. We gotten some good perspective on different how it's viewed tonight. A lot of people are all about the convenience, and they have better things to do in life than try to figure out how to trade or what to buy or things like that. And they say, you know what? Just give me the simplified Trader Joe's menu where I get pasta sauce or I get ketchup, and I don't want 57 different times. Just give me a thing. And that is oftentimes worth that cost of having that product in there. The ETFs also open up a very interesting way to put wagers and investments on something that might grow, especially expand. Think of the internet, pre-bubble and post-bubble. After the crash, people still put money in internet companies and digital companies and things like that. And look at society today, 20 years later. Very, very digitized. That's where all of the big high-flying names is in that tech sector. And that's just something when your time horizon is decades rather than weeks, right? That makes sense. And to be able to have that type of exposure in that decade type account time horizon, it makes a lot of sense. And so it goes back to that message that we talk all the time on Blockhead Traders is there is no right and wrong thing to trade. There's a right and wrong thing for you. And you have to know your risk tolerance. You have to know your trading objectives and what fits that for you. How are these products constructed? What's under the hood? How do they work? That common theme kind of echoes throughout all of this. So a lot of fun today. A lot of action out there on the market. We're really just breaching all-time highs on tons of the indexes right now. Are we going higher? Are we going to look for a correction? Who knows? But for those of you that are out there trading, good luck finding things that excite you to trade. Good luck in what you're trading. And remember, think outside the block.